The $2 trillion private credit market is hiding leverage that would make 2008 look like a dress rehearsal, and it's about to blow up. I'm going to show you exactly how and why institutional investors keep throwing money at it anyway. Listen, we've talked on this channel about inflation, layoffs, housing cracks, and consumer pain. But there's a parallel financial system, private credit, that's about to amplify all of that suffering. And most people have no idea they are already exposed to it. Let's start with what private credit actually is, because the marketing is deliberately confusing. Private credit funds are basically shadow banks. They lend money to companies that can't or won't go to traditional banks. On the surface, this sounds good. Businesses get funding, investors get 8–12% returns in a low-rate environment. Win-win. Except it's not. What these funds are actually doing is lending to overleveraged companies with deteriorating fundamentals at terms that traditional banks rejected. Then they bury the real leverage ratios in footnotes, call it alternative investment, and sell it to pension funds, insurance companies, and wealthy individuals as a safe yield play. Here's the trap. When the economy is expanding and interest rates are falling, private credit looks genius. Companies service their debt, asset values rise, returns hit 10–15%, investors pour more in, but recession doesn't care about your IRR spreadsheet. Let me show you the 3 bombs ticking inside the private credit market right now. Bomb #1. Covenant-lite loans ***. A traditional bank loan comes with covenants, financial guardrails. If a company's debt-to-EBITDA ratio exceeds a threshold, or if cash flow drops below a level, the bank can take action. They can force a restructure. They can tighten terms. Private credit funds said, forget that. They pioneered covenant-lite lending. Companies can burn cash, miss earnings targets, and load up additional debt, and the lender can't do a thing until the loan matures. This was supposed to be attractive because companies paid higher rates for the freedom. What it actually created was a pile of loans to companies whose fundamentals are degrading in real time, and lenders are watching it happen powerless. When recession hits, these companies will default. Not maybe, will. Bomb #2. The maturity wall ***. Look at what's coming in 2025–2027. Over $500 billion in private credit loans are maturing. These companies, many of which bought themselves with leverage in 2021–2022, now need to refinance. Refinancing in a stable market, fine, but refinancing into a tightening credit market, higher rates and weaker earnings, that's a cliff. Here's the dirty math. A company borrowed $500 million at 4% in 2022. That loan matures in 2025. Interest rates are now 7%. The company's EBITDA has shrunk 15% due to layoffs, consumer pullback, and tariff pressure. Private credit funds won't touch it. Traditional banks won't touch it. So what happens? The company misses the refinance, default, asset sale at 40 cents on the dollar. Investors take a 60% haircut, but here's where it gets systemic. These defaults cascade. A default in one portfolio company spooks other lenders. Credit dries up. More companies can't refinance. More defaults. It feeds itself. Bomb #3. The Leverage Masking Act ***. This is the dirty one. Private credit funds advertise using metrics like net leverage or leverage adjusted for CapEx. These are accounting contortions that would make an Enron CFO blush. Real leverage, gross debt divided by actual cash flow, is often 6x to 8x, sometimes higher. For reference, 4x is considered risky. 3x is healthy, but funds bury this in the fine print. They massage EBITDA figures. They add back one-time costs. They subtract expected future cost cuts that never materialize. The result: investors think they're lending at 3–5x leverage. They're actually at 6–5x leverage. The interest rate they're getting doesn't compensate for that risk. When earnings compress, and they will, these loans implode. Why is this happening now? 2 reasons. First, the Fed. For 15 years, the Fed flooded the system with cheap money. This created a hunt for yield. Private credit offered 8–12% returns. Pension funds, desperate to hit return targets, poured billions in. Second, regulation avoidance. Traditional banks face capital requirements, stress tests, and oversight. Private credit funds face almost none. They can take bigger risks, offer higher rates, and not worry about regulators asking questions. It's a regulatory arbitrage, and it's been incredibly profitable. But here's the thing. The Fed is done with cheap money. Rates are high. Money is tight. And the Fed is actually removing liquidity, quantitative tightening, which means there's less air in the system for these overleveraged companies to breathe. We're in the window where private credit funds are about to face the biggest test since they became a major asset class. Asterisk asterisk, what happens in a recession? Asterisk asterisk, defaults spike. Not linearly, exponentially. If base default rates go from 2% to 6%, which is normal recession stuff, that wipes out 3-4 years of returns in a single year. But it's worse than that. When private credit funds start taking losses, they have to mark down their entire portfolios. Investors see their 8-12% annual returns turn into -25% in a bad year. Then redemptions happen. Investors panic and ask for their money back. But private credit is illiquid. There's no secondary market. Funds have to start fire-selling assets to meet redemptions. Fire sales drive prices down further. More losses. More redemptions. It's a death spiral. And if you're exposed through a pension fund, insurance policy, or a fund of funds, you're getting crushed without knowing why. Asterisk asterisk, here's what to watch. Asterisk asterisk, first, maturity schedules. If you're in a private credit fund, demand to see what's refinancing in 2025-2027. If more than 20% of the portfolio is maturing, that's high refinance risk. Second, leverage metrics. Real leverage. Gross debt to EBITDA. If they won't give you that number, they're hiding it. Third, default rates. Private credit funds will try to bury default news in quarterly reports. Watch for it. Fourth, redemption gates. If funds start locking money in, saying you can't withdraw for 6 months or a year, that's a sign of trouble. Asterisk asterisk, the bottom line. Asterisk asterisk, private credit funds marketed themselves as alternative investments, offering safe, steady returns. They're not safe. They're not steady. They are leverage bombs dressed in compliance clothing. When recession hits, and all the signals suggest it's here or imminent, these funds will blow up. Investors will get crushed. And because $2 trillion is a massive amount of money, the ripple effects will spread through pension funds, insurance products, and institutional portfolios. This is the hidden recession risk nobody's talking about. If you're tracking inflation, layoffs, housing shifts, and consumer pain,